E. Manage trade financing, including letters of credit. Trade financing is an important treasury function that supports domestic and international commerce by facilitating the movement of goods, reducing payment risk, and improving working capital efficiency. Treasury professionals manage financing arrangements that help organizations purchase inventory, fund production, and settle cross-border transactions while maintaining adequate liquidity. Because international trade often involves unfamiliar counterparties, legal systems, currencies, and shipping processes, Treasury teams must implement structures that provide payment assurance to both buyers and sellers. Effective trade financing improves supply chain stability, strengthens vendor relationships, and supports global business expansion. Treasury professionals evaluate financing costs, credit risk, transaction timing, and banking capabilities when selecting appropriate trade finance instruments and strategies. Letters of credit are among the most widely used trade financing instruments because they reduce counterparty risk in commercial transactions. A letter of credit is a bank-issued commitment guaranteeing payment to a seller if specified terms and documentation requirements are satisfied. Treasury professionals coordinate with banks, suppliers, shipping companies, and internal departments to ensure proper documentation and compliance with contractual terms. Common documents include invoices, bills of lading, insurance certificates, and inspection reports. Letters of credit provide sellers with greater assurance of payment while allowing buyers to negotiate favorable trade terms. Treasury professionals must understand issuance procedures, fees, expiration dates, and discrepancies that could delay payment or increase operational risk. Several types of letters of credit are used depending on transaction requirements and risk considerations. Commercial letters of credit support standard trade transactions by ensuring payment upon presentation of compliant documents. Standby letters of credit function as secondary guarantees that become payable only if the applicant fails to fulfill contractual obligations. Revolving letters of credit support ongoing trade relationships by automatically renewing availability within predefined limits. Confirmed letters of credit add an additional bank guarantee, reducing exposure to political or banking risk in foreign jurisdictions. Treasury professionals assess creditworthiness, country risk, transaction value, and regulatory considerations when determining which structure best supports the organization's operational and financial objectives. Trade financing also includes financing arrangements such as documentary collections, trade loans, supply chain financing, export financing, and receivables financing. Documentary collections involve banks facilitating payment exchange without guaranteeing settlement, making them less secure but generally less expensive than letters of credit. Supply chain financing programs allow suppliers to receive accelerated payment while buyers extend payment terms, improving working capital management for both parties. Treasury professionals evaluate financing alternatives based on liquidity requirements, borrowing costs, operational complexity, and risk exposure. Effective trade finance management requires close coordination with procurement, logistics, legal, tax, and banking partners to ensure efficient transaction processing and regulatory compliance across international markets. From a CTP examination perspective, candidates must understand the objectives, mechanics, and risk management considerations associated with trade financing activities. Exam questions frequently assess the ability to identify trade finance instruments, evaluate financing alternatives, interpret letter of credit structures, and analyze transaction risks in international trade environments. Candidates should understand the roles of issuing banks, advising banks, confirming banks, and counterparties involved in trade finance transactions. Knowledge of documentation requirements, payment terms, country risk, foreign exchange implications, and working capital impacts is also important. Mastery of these concepts enables Treasury professionals to support secure commercial transactions, strengthen liquidity management, and facilitate efficient global trade operations.